As markets navigate volatility and higher rates, investors are looking for new sources of income. Danielle Gilbert is a managing director of Eldridge. She's here with me now to talk about finding this income. Danielle, great to have you at the desk.
So great to see you, Caroline.
So this is an ETF spotlight. The funds are CLOX and CLOZ, the Eldridge AAA and BBB CLO ETFs. We'll get into those in just a second, but let's start broad because we're hearing a lot about CLOs. But I would assume that the average retail investor might not know all that much about them. So what do we need to know? Why are they so popular right now?
Well, I don't think it's a right now thing. The thing about CLOs is they've been around for 30 years and they've performed very well through cycles, but they've only been accessible to the institutional investors until more recently. So yes, it's not a right now, meaning they're only great right now. They've been great for many years. The right now aspect of it is the access. So when people ask, like, what is a CLO at the end of the day, what you're getting access to is a pool of senior secured loans to mid-cap, large-cap companies, largely U.S. Your investors know equities. They're investing in equities to these companies, but this is a loan to the company, so it sits at the top of the capital structure. But these loans are pooled and actively managed by credit managers. So you have a lot of diversity in a CLO. You have a lot of diverse exposure. There's no big bets on any specific industry. There's no big bets on any specific name. And there's this active management component. So in the current market, it really is a vehicle that gives you diversity. But the best part about it is it's floating rate income. So think about that with what's going on in all the volatility in rates right now. So you have this large asset class. Another thing that people aren't familiar with is just the sheer size of the asset class. It's almost 1.3 trillion. Just to put that in context, the size of the US high yield market is around 1.4 trillion. So they're almost the same exact size, but it wasn't until recently that the individual investor or even the institution could get access in a daily liquid wrapper with low minimum and have a lot of transparency on the value of the underlying.
So you talk about the fact that they're performing well. Talk to us about what sort of returns we could expect to see.
Sure. So the returns are going to be driven by a couple different things. One is this is a floating rate product. So you have base rates plus a credit spread. In the market today, what we're seeing, I checked before I came here, the SEC yield, which is really, again, this is a yield-driven product. The SEC yield on our AAA product, which is really your capital preservation product, is around 4.75. That's 3 months SOFR plus around 100 to 120 basis points, depending upon where AAA spreads are. But where people get really excited is on the income side, which is CLOZ, because this is a daily liquid product that's earning north of 7.5% yield. That's delivered monthly to the investor. Again, at a very low minimum, one share is around $25. So people have a lot of choice. What we see is investors blending them, maybe sometimes doing a 50-50 split, but they'll sometimes tilt to a more defensive AAA overweight, or they'll tilt to more income-oriented overweight. But it's really just a useful way to get income in your portfolio. And again, institutions have been using these products for decades. It's just now, recently in the past few years, opening up to the individual.
And Eldridge offers both. I mentioned CLOX, there's also CLOZ. If I already own bonds in my portfolio, why do I want to own CLOX or CLOZ?
Well, I think it's actually a complement to a portfolio. Everybody talks about the 60-40 portfolio. And what we saw, and I think this was obviously very elevated in the 2022 rapid rising environment, is that you can't ignore duration risk. The total return for the 30-year Treasury at the end of 2022 was negative north of 30%. To put that into context, CLO AAAs were actually positive that year. What happened after that? We saw the regional bank crisis. A lot of banks who have the short-term deposits and then invest on their own balance sheet were invested in longer duration treasuries or products. So they were saying, okay, we've taken some credit risk off the table, but we have a lot of duration risk. What you see with CLOs is you take that duration risk off the table. So you're able to arm yourself in these volatile rate environments because you're just getting the pass-through of whatever the floating rate is, base rates, which is closely tied to SOFR, plus the credit spread. So what we've seen from performance is it's been very steady and very resilient. But I think with any credit product, when you're talking about performance, you're talking about risk metrics and you're talking about losses. In the history of the CLO market, there has never been a AAA CLO ever default. Since 2010, there has never been a AAA, AA, single A, or triple B default. These are just these are the ratings of the bond spectrum because you can have different choices. And for double B, it's been less than 1%. So that means that I'm earning my income and I'm really protected on the loss. And it's because there's this inherent buffer that you have at the bottom that protects from loss. Because other people would say, well, why not just invest in a loan fund or a loan ETF? It's diverse, it's actively managed, it's senior secured risk. What you're missing in a loan fund versus a CLO fund is you don't have the structural buffer that wraps the bonds from any kind of losses.
So what is the biggest risk that investors need to be aware of when investing in CLOs? And on that note, I guess, what is the biggest misconception about them?
Well, I'm going to answer two different questions there because these are always fun to answer. I would say the biggest risk that you're going to see is really volatility in spreads.
Okay.
Right? Because a lot of it can be sediment driven. The great thing about CLOs now fitting in the wrapper is, and the reason why they fit into the ETF wrapper is because of liquidity. So this is a market that last year traded over 200 billion, and we're seeing monthly flows now north of 20 billion. So you're seeing increased liquidity. That's why it fits inside an ETF wrapper. There's a lot of talk right now about private credit. This is not private credit. The underlying are broadly syndicated loans, and there's a lot of visibility, daily marks, and there's a strong secondary market.
Dig into that before you get to the second part, though,
Okay.
because I do think that there are a lot of concerns about the credit markets right now. We talk about that as a headwind for the equity market even. This is not that. There's a clear differentiation.
This is credit exposure, but honestly, it's a great place to be defensive right now because I'll just use software as an example. The software exposure within the BDCs that we're hearing about today could be anywhere from like 26 to 28%. Within the loan index, it's around 15%. Within CLO portfolios, you're seeing anywhere from 10 to 11%, but you saw managers positioning and de-risking and underweighting the software sector even leading up to the recent turmoil. Because remember, there's this active managed component to it. So the AI news and AI underwriting isn't new, and they were able to position because it's so actively managed. When we're investing in a CLO, we're looking at two things. We're looking at who the manager is, that's tending to that pool of CLOs, but we're also looking at the exposures of the underlying, and we're really trying to mitigate any kind of tail risk in the portfolio. But at the end of the day, I want to remind your viewers that this is loan risk. So if you just think of a corporate capital structure, you have the loans that sit at the top of the capital structure, you have the unsecured debt that sits underneath that, and then you have the equity. So some of your viewers could be maybe exposed to equity, but they might be dealing with more volatility. And the benefit of kind of sitting at the top is you're collecting income that can compound. So it's just a different way of generating total return that you would get maybe without the volatility of the ups and downs that you would get with equity.
So just to clarify then, what do CLOs offer that traditional fixed income might not? You say it's a complement.
Well, by the way, I need to answer your misconception question.
Right. I'm sorry.
I was like, that's okay, because you're like, let's go on this path, which is awesome. But I can't.
The misconception.
The misconception is that people often conflate CLOs with CDOs.
Okay.
And they're not. And I think it's important to explain why they're different. So again, I can't believe we're still talking about the global financial crisis, but we're now in a different version of a crisis. But CLOs rhyme with CDOs. The structure of like pooling assets together and tranching them out are very similar. That securitization. What is so starkly different is the collateral. So the collateral that around the global financial crisis was not diverse. It was to a subprime borrower, and it was mortgage credit. So the collateral that goes into a CLO is corporate collateral. It's hyper diverse, and these are to large companies that you would recognize. But also what's so important is those were static pools.
Sure.
And so the CLO pools are actually actively managed. And what you see is just the performance has been incredible from one versus the other. I think there was 25 billion of AAA CDOs that wiped out, and there were 0 AAAs, but they're starkly different asset classes. So I love telling people, but I think when you dig into the numbers, and that's honestly why this asset class continues to grow, because it's offering floating rate income, it's super resilient, and it's outperforming what you have versus other rated products.
But a bit more nuanced and complicated. So going back, thank you for keeping me honest about the misconception question. I tried to remind myself to go there.
You and I were
then
talking about that, right?
But as we think about adding CLOs versus traditional fixed income, is this all about yield, or is there another benefit? What's really the takeaway for investors as they think about, why do I need this?
I think it's probably 3 things. You can't talk about CLOs without talking about yield. It's floating rate yield, it's scalable, it's diverse yield. Okay, all those things are really important right now in the environment. But then the next component I would say is a historical track record. And the fact that when I'm investing as a debt investor, I want to earn that income. I want that income to compound, but I also want to make sure that I'm mitigating any kind of loss or principal loss. The CLO track record is incredible for that. And then I would say the third component is the structure and the cushion on losses. So let's just say in the portfolio, a CLO portfolio, which one CLO makes up 200 to 300 little tiny pieces to big companies. And then what we're doing in our ETF is we're bundling those and then offering that very diverse income stream. But let's just say that one loan has an issue. Remember, it sits at the top of the capital structure, so it doesn't get wiped out. There's going to be a recovery, and long-term historical recoveries on loans are around 65 cents on the dollar. But let's just say there's an issue. What happens is it first eats into what's called the CLO equity, which sits beneath the bonds. And so you don't have any impairments happening on day one to the debt stack. And the reason why AAAs are paying 120 and BBs are paying 650 over, that's the credit spread, is really just in the priority of the cash flow. So the buffer at the AAA is really high and the buffer at the BB is smaller. But at the end of the day, these are just floating rate income products. They're diverse, they're super resilient, and they're not in the ag. You do find them in core plus portfolios. But what's great is now that CLO ETFs exist, investors have a lot of choice. So they can choose how they want to use CLOX, the AAA product, for capital preservation, or CLOZ to really drive and activate income in their portfolios.
Danielle, before we let you go,
okay,
we play a rapid fire game of this or that. Are you ready to play with us?
I'm ready.
All right, quick questions, quick answers.
Okay.
Here we go. Higher for longer rates, a headwind or tailwind for CLOs?
Tailwind.
Fed done hiking or not restrictive enough?
Ooh, I think probably TBD, because there's a lot going on right now.
We'll certainly see. Credit markets, resilient or starting to crack?
Depends on what part, but I'm going to go with resilient still.
Defaults, contained or about to rise?
I think you'll see some rising defaults.
Spreads, too tight or fairly priced?
Again, it's highly dependent, but I'm going to say too tight.
Income, lock it in or wait for better entry?
I would lock in floating rate income.
Fixed income, is the 60-40 back or is it still too early?
I think it's gone. There's other ways.
What should the percentage be?
Oh, well, I kind of like the 60 to 50 in equities. And then I think in income, you can find other robust income solutions. So I would say have your ballast still be the core of what makes up the ag, and then consider adding maybe 15 to 20% to others.
Bonds, real competition for equities or just a complement?
Just a compliment.
The bigger threat, liquidity drying up or credit quality sliding?
I think credit quality sliding.
Didn't realize that would be a tongue twister for me. Recession, priced in or still ahead?
I don't see it immediately.
Volatility, opportunity or warning sign?
Always an opportunity with the right partner.
Investors, reaching for yield or being selective?
Right now, I would say investors are cautious.
One word to describe credit right now?
Resilient still.
What's one thing investors are getting wrong about this market?
I think what they're getting wrong is it's sentiment driven. oftentimes, and when you look at the data, it's not as bad as people really are making it out to be.
We'll leave it there. Danielle, really
you.
appreciate your insights. Thanks for playing along.
Thank
That's
you.
Danielle Gilbert, Managing Director at Eldridge.